You are welcome to my channel once again. For the benefit of those who are watching me for the first time, I will introduce myself. My name is Daniel Amakun, an ACCA chartered accountant. I've provided accounting services such as bookkeeping and others for more than 20 years. I also teach accounting. Today, the subject we are going to learn is trading profit and loss account. I don't want to waste your time. Let us get into the video. I've prepared these simple notes for us to go through gradually so that at the end of the day, you will be able to understand trading profit and loss account. Before we start, trading profit and loss account is one of the most important subjects in accounting. If you are an accountant and you don't know how to prepare the trading profit and loss account, then you are not really an accountant. So please go through gradually with me and pay much attention so that you really master the trading profit and loss account. Other than that, you'll be an accountant. You can be a chartered accountant if you don't know how to prepare the trading profit and loss account. Every organization that employs you will definitely sack. So, and after they say practice make man perfect. After watching this video, go over, you can record it and go over several times, because what accounting is a principle. And the more you watch it, the more you go over it, the more you understand it, and the more the principle becomes familiar to you. So let us start. Introduction to the trading profit and loss account. Our learning objectives today are: 1, A, to prepare trading accounts so as to calculate gross profit. B, to prepare profit and loss accounts so as to calculate the net profit. Okay. The aim of every business is to be successful. That is to make profit but not losses. Due to this, usually every month, a business owner may want to know the outcome of the trading activities. Hence, in this chapter, we are going to learn how to prepare trading profit and loss accounts, or the income statement. That's another name for trading profit and loss account as well, the income statement. There's a format for doing this, but I prefer taking my time to explain the format step by step so that it will be well understood instead of memorizing them. We usually balance all the accounts. And at the end of the month or year, send the figures to the trial balance before using the trial balance figures to prepare the trading profit and loss accounts. Also, the trading profit and loss accounts can be prepared horizontally or vertically. Since the vertical presentation is the most popular, we are going to use that one. Let me explain. All that I'm saying here is that every business wants to make profit. So at the end of the period, the business owner will want to know the profit of his or her trading activities. And it can be prepared as a trading profit and loss account should be prepared either at the end of the month or at the end of the year. We prepare it at the end of the month so that they will know the trading activity, whether it's profitable or not during that particular month, and also at the end of the year so that we assess the total performance of the business. So that if the business underperforms, then the business owner can put in corrective measures to ensure that the subsequent year or the business becomes profitable. And the trading profit and loss accounts, normally they have a format, and the format you memorize it so that you can apply it. But I prefer explaining the format to you so that you understand it. When you understand the format, applying it is very easy. But when you memorize it and you forget it, that means you can't prepare trading profit and loss account. That's why I've taken my time to prepare this notes, go through with you, so that at the end of the day, you understand it. You go through step by step gradually. And as I've said or stated in the notes, the trading profit and loss account can be prepared in two ways, horizontally and vertically. But I prefer the vertical presentation because what it is the most popular one. So let us go through. The calculation of the trading profit and loss accounts in two parts, namely I take it again. The calculation of the trading profit and loss account is in two parts, namely trading accounts and the profit and loss account. The trading accounts, A. The purpose is to find out whether profit or loss has been made from the main trading activities, that is buying and selling activities of the organization. The outcome is known as gross profit or loss. So let me explain. The trading profit and loss accounts is in two parts. We have the trading activities and we have the profit and loss activities. All that I'm saying is that for the trading activities, in order to be able to do the trading activities, you take the organization trading, buying and selling during the period. Then when you do that, at the end of the day, you arrive at what? The profit or loss. Then after that, after getting the profit and loss, we go over to the second step. That is the second step was you deduct all expenses from the profit or loss so that you get what? Net income. So what we are going to do now is that we are going to take the first step and prepare the trading activity so that at the end of the day, we come out with the gross profit. So B, finding the gross profit. This is simply the sales, that is SP less the cost price, that is CP. For example, if an item is bought for $50 and sold for $120, the net profit is calculated as follows. Sales $120, less cost $50. The gross profit is $70. So what I'm trying to explain here is that in order to get the gross profit, we take all the trading activities of the buying and selling, so that at the end of the day, you get what your gross profit. And it simply means you take your sales, here you deduct it, the cost. And here, I mean what? You take the sales, which is the selling price, then you deduct the cost. So the example I've given here that if an item is bought for $50 and sold for $120, how do we get our gross profit or loss? We take the sales $120 and deduct the cost $50, so that we arrive at a gross profit $70. Let's continue. It is this same idea that is applied in the trading account. So let us start step by step. So it's the same idea, selling price minus cost price, that is applied in the trading account. So let us go on. So C, sales and purchases only. So we are dealing with sales and purchases only. Example, Ivan bought goods for $100,000, and sold it for $250,000. So how are we going to calculate it? So sales with the selling price, $250, less purchases with the cost price, CP, $100,000, and the gross profit is what? $150,000. Now let us add more. Opening stock, closing stock, goods available for sale, and cost of goods sold. So we are going to explain all this. So let us continue. I, opening stock. Opening stock means this is the goods unsold or that remains at the start of the trading period. So after the trading activity, the business will realize at the end of the day, they will have some of the goods remaining. In accounting, we call it what? Opening stock. Opening stock. Then CII, closing stock. This is the goods that remain unsold at the end of the trading period. Let me explain the opening stock and the closing stock. At the end of the trading activity, there are goods that will remain, that we call it for the current period is a closing stock. But when it's carried to the subsequent period, then it becomes an opening stock. So, for example, let's say the business is trading in June. Whatever goods that will remain in June is closing stock for June. But when it's carried down to the next month, which is July, it becomes an opening stock. Okay, let us see the meaning of goods available for sale. A trader will ensure that there are no shortages of stock during the trading period, so as to meet customers' demand. Apart from the opening stock from the beginning of the trading period, a trader will buy more goods to add to what it is in stock already. So the opening stock added to the purchase will result to the goods that the trader has at the end to sell to the customer. This is called goods available for sale. So let me explain. At the beginning of the month, there will be some goods remaining. So we say opening stock. But the opening stock, when the business owner realizes that it will not be sufficient to meet the needs of the customer, the owner will buy more goods. So that one we call it purchase. So when we take the opening stock and we add it to the purchases, then we will have total goods available for the business to be sold to the customer. That's why we say that it's goods available for sale. I hope it is well understood. Let me go over again. It is the opening stock for the period added to the purchases so that we know what we get and know what the goods available for sale. Let us continue. IV, cost of goods sold. Since some of the goods will remain during the trading period called closing stock, then the trader should ensure that the closing stock is deducted from the total goods available for sale to know the actual cost of goods sold. For what has not been sold, has not generated sales yet. So that the actual goods sold will be matched against its actual cost. All that has been said above can simply be illustrated as follows. So let me explain. When we take the opening stock, you add it to purchase, you get goods available for sale. But when there are goods remaining at the end of the period, it will be deducted from the goods available for sale so that we know the actual cost of goods sold. What I mean that when goods has not been sold, it cannot be generated it cannot generate an income. So if you want to know the actual cost of goods sold, then we take our total goods available for sale, which is the purchases added to the opening stock. Then we deduct whatever goods remain so that we know the actual cost of goods that has been sold and has generated that particular income. So let us look at, so our format is now what? It's being illustrated as follows. Since that the selling price is here, then you take your opening stock, which is this. You add purchases, which is this. So you get your goods available for sale. Then you deduct the closing stock so that you know what the cost of goods sold. When you know the cost of goods sold, then you take your sales, you deduct the cost of goods sold so that you get your gross profit. So let us look at an example. Even so, goods in stock at the beginning of the trading period worth $50,000. During the period, he bought additional goods costing $70,000. He sold some of the goods to a customer for $110,000. At the end of the trading period, the goods remaining was $40,000. Calculate even profit or loss for the period. So the solution, the sales is $110,000, which is this. The opening stock is $50,000, which is this. The purchase is $70,000, which is this. And the closing stock is $40,000, which is this. So let us put it into our formula. A a sale where the selling price $110,000. Our opening stock $50,000, which is this. Our purchase is $70,000, which is this. So the opening stock plus purchases, we get goods available for say 120. Then we deduct the closing stock $40,000, which is this. So our cost of goods sold is $80,000. This is $110,000 minus cost of goods sold $80,000. We get a profit of what? $30,000. Our goods available for sale is what? $120,000. I'm explaining. Our goods available for sale is $120,000, which is this. How do we get it? Is the opening stock added to the purchases? That the 50,000 added to the 70,000, which is this plus this. Then we get this. Deducting the closing stock of 40,000 resulted in cost of goods sold of what? 80,000. So 120,000 minus 40,000, $120,000 minus $40,000. We get our cost of goods sold of $80,000, which is this. Then finally, deducting the sales $110,000 from it, we arrive at a gross profit of $30,000. So $110,000, this is minus cost of goods sold $80,000. We get a profit of $80,000. Sorry, $30,000. It can be seen that it is very easy to arrive at a gross profit. The most important thing is to understand what you are doing and identify the figures there. So as I said, you have to understand what you're doing. You identify the figures, then you put into whatever formula you have or step you have, then you arrive at your gross profit or gross. Notice that the closing stock of $40,000 will be carried forward to the next period as opening stock. So we have a closing stock of $40,000. It will be carried on to the next month as what? Opening stock. Let us add more. Now we come to the E. What's the meaning of sales returns? That is return inwards. And purchases return, that return outwards. Okay. We treated this when we were discussing the trial balance. However, we will go over it again and include them in our trading account. What I mean is that I've made a video for this particular subject. So you can click on the link below to go and watch that particular video. Let us go. I, sales return. That's returning us. Occasionally, some of the goods sold to customers will be returned by them due to many reasons, such as damaged goods whilst in transit. Since it is returned into the organization, in accounting, we call it return inwards. To arrive at the actual sales for the period, it should be the data from the sales so that the sales is not overstated. What I mean here is that at times you sell goods to customers so that the business will derive an income, we call it sales. But the customers may return some of the goods due to damage or let's say sending the wrong goods. So if you want to know the actual sales for the period, is you take the sales, then you deduct whatever has returned to the organization. In accounting, whatever goods returned to an organization is returned inwards because it is coming back to the organization. Let us continue. I return outwards. The same thing, a company may return some of the goods purchased. Since it's going out of the organization, in accounting, it is returned outwards. It should be deducted from the purchases so that the purchases will also not be overstated. What I mean is that they say, a business may purchase goods, but to realize that some of the goods may be faulty or wrong good supplied, then they have to return it back to the owner. They are returning it out of the business, so we say it's returned outward. So in order to know our actual purchases, we take the purchases, then whatever has been taken, we deduct it so that we get actual purchases, so that the purchases figure will not be overstated. Let us continue. So looking at our formula now, including all that has been said about sales this year, let's return inwards, whatever the customer has returned, so that we get our net sales. That is the sales minus the return invoice, we get our net sales. Then we take our opening stock. Our purchases is here, but whatever we have also returned back to the owner, we did that so that whatever we get, then we add it to our opening stock so that we know our goods are available for sale. When we know our goods are available for sale, then we deduct our closing stock. Then we know the actual cost of goods. Actual cost of goods, we take our net sales. We deduct it from actual cost of goods, we arrive at our gross profit. So let us look at an example. Example, Mr. Evans continued the business for the following month with opening stock of $40,000 and bought extra goods worth $250,000, but returned $20,000 damaged once. He sold some of the goods for $280,000, but the buyer returned $30,000. If his closing stock is $80,000, prepare his trading profit and loss for the period. So let us put it into our system solution. Our sales is $280,000, which is this one. Our return invoice is $30,000, which is this one. Our opening stock is $40,000, which is this one. Our purchase is $250,000, which is this one. Then return afterwards is $20,000, which is this one. Then our closing stock is $80,000, which is this one. So let's see. This is $280,000, this one. Let's return in what? $30,000, which is this one. Our next is now $250,000. $280,000 minus $30,000, which is $250,000. So we have our opening stock. Our opening stock, $40,000, this one. Then our purchase, $250,000, this one. Let's return out to $20,000, which is this one. So $250,000 minus $20,000, we get at $30,000. Then we add it to our opening stock. We arrive at what? Goods are available for sale or $270,000. Then we deduct our closing stock, which is $80,000. So $270,000 minus $80,000. We get our cost of goods sold of what? $150,000. So the net sales of $250,000 minus our cost of goods sold $150,000. We get a profit of what? We get a profit of $100,000. So $250,000 is minus $150,000 cost of goods sold. We get a gross profit of $100,000. So let me explain. The net sales is $250,000. It's obtained by deducting the return invoice of what? $30,000 from the sales. From the sales of $280,000, which is $280,000 minus $30,000. So when we come here, sales $280,000, my return was $30,000. We get what? Net is $250. The purchase is $250,000. It's also deducted by, it is also reduced by return afterwards of $20,000. So $250,000 minus return afterwards $20,000. So the actual purchases become $20,000, which is, so opening stock $40,000. We have it here. Purchase $250, return after $20. The total $250,000 minus $20,000. We get what? $230,000. We add it to our opening stock. So that we get what? $270,000. Then we deduct the closing stock. We get cost of goods sold $150. So that's what I'm explaining here. So the actual purchases become $230,000, which is added to the opening stock of what? $40,000. So $230 plus $40,000. The outcome is goods available for sale of $270,000. The closing stock of $80,000 is then deducted. $270,000 minus $80,000. And the cost of goods sold of $150,000 is what is obtained. Finally, the cost of goods sold, $150,000, is deducted from the net sales, $250. That is $250 minus $150. And a gross profit of $100,000 is the outcome of the trading activity for the period. Again, the closing stock of $80,000 will be carried to the next period as opening stock. So all that's what I'm explaining here. Says $280,000 less return was $30,000. Next is $250. $250,000. Opening stock $40,000. Purchases $250,000. Less return out of $20,000. We have $230,000 added to the opening stock $40,000. So goods are available for say $270,000. Less closing stock $80,000. Cost of goods sold $150,000. Next is $250,000 minus cost of goods sold $150. We get a gross profit of $80,000. There's still goods of $80,000 remaining, which is the closing stock. This particular one will be carried on to the next period. Let us continue. Now let us add more things. Carriage inwards and outwards. What's the meaning? Carriage inwards. When goods are bought from a supplier, there may be additional cost of transportation incurred to bring the goods to the customer warehouse or business premises. This is known as carriage. If this is paid by the customer, then it becomes carriage inwards to the customer. This should be added to the purchases price to determine the total cost of goods to the customer. So what that I'm saying is that at times the business will go and buy an item from a supplier, and there will be some means of transportation in order to carry the goods to the business owner's premises. Then to take to the warehouse or whatever goods are kept, because the owner will pay for the transportation. Definitely, when we want to know the purchases for the day, we have to add it to the purchase so that we know that total cost of purchase. Otherwise, the purchases will be understated. Okay, that's what carriage was. Now, what I carriage out was in the same way. If it is paid by the supplier, then it becomes an expense to him and should be treated in the profit and loss account. The accounting format can be seen as below. What I'm saying is that in case the supplier decided, I want to allow the customer to pay for the transportation, but I will pay for it myself, then it becomes what? An expense to the company, so that what? You treat it as a carriage inwards. It is a loss to the company's expense. So it will be treated, or it will be added to the total expenses of the business. Let us look at when we add the carriage. So we have our sales. Let's return inwards, which is this figure. So this when we return inwards, we have our next sales. Our opening stock this year. We have our purchases. We add any carriage inwards. Carriage inwards is the owner pay for the transportation with carriage inwards. We have our total purchases. Then any goods that has been returned by the owner back to the supplier, we deduct it so that at the end of the day, we have our total purchases. Then we add it to our opening stock. We get goods available for sale. Then we deduct our closing stock. When we deduct our closing stock, we get what? Cost of goods sold, which is the figure. We take our net sales, we deduct our cost of goods sold, we get what? Gross profit. One thing that you should note, any carriage outwards will be treated as an expense in the profit and loss account. So what I'm saying that The trading accounts only, we do the trading account in order to get what? Our gross profit or loss. Then any expenses will be deducted later. That you go on to from the trading account, you go on to the profit and loss account. The profit and loss account that we take our gross profit or loss, then we deduct any expense. But when the owner, he pays for that particular transportation, then it becomes expense to you. So when we get our gross profit in our profit and trading loss accounts, when we get our gross profit, then we will have to add all the expenses, include the carriage outwards. We have to include the as expense and deduct it from the gross profit in order to arrive at our net income. Okay. So let us look at an example. Mr. Evans continued the business for the following month with the opening stock of $80,000 and bought extra goods worth $300,000, but returned $10,000 as damaged goods. As damaged ones. He incurred extra transportation costs of $6,000. He sold some of the goods for $410,000. But the buyer returned $15,000. If his closing stock is $60,000, prepare his trading profit and loss account. So says $410,000, which is this. Returning was $15,000, which is this. Opening stock $80,000, which is this particular one. Purchase is $300,000. Which is this particular one. Return out was $10,000, which is this particular one. Then carriage in was $6,000, which is this one. Then closing stock $60,000. Which is this one. So let us go through. Our sales is $410,000. This particular one. Return in was $50,000. This $410,000 minus $15,000. We get $395,000, which is our net sales. Our opening stock $80,000. This one. We take our purchase $300,000, which is this one. We add our carriage in was $6,000, which is this one. In total, $300 plus $6,000. We get $306,000. Then we have to add our return was $10,000, which is this one. So in all, $306,000 added to $10,000. No, $306,000 deducted from $10,000. Please, sorry for the inconvenience. So we have our purchase is $300,000. We add a carry $6,000. In all, we have $306,000. Then any return outwards, which is $10,000, is deducted. We have $296,000. We add it to our opening, so $80,000. We get goods available for sale, $376,000. Then we deduct our closing stock, $60,000. So we arrive finally at a cost of goods sold of $316,000. We take our sales of $395,000. We deduct our cost of goods sold of $316,000. Our gross profit is now $79,000. So that is all that I'm explaining here. The net sales is $395,000. It's obtained by deducting the return invoice of $15,000. $15,000 from the sales of $410,000. So $410,000 minus $15,000, we get what? We get our $395,000 as what? Our sales. So I'm explaining how we arrive at our sales, as I've explained already. It's just $410,000 minus $15,000 return. Then we get $395,000. Okay. The purchases of $300,000 has been increased to what? $306,000 by adding what? The carriage invoice of $6,000. That is $300,000 plus $6,000. This is also reduced by return outwards of what? $10,000, which is $306,000 minus $10,000. The actual purchases becomes $296,000, which is added to the opening stock of $80,000. So $296,000 plus $80,000. Okay. The account is goods available for sale of $376,000. That is this plus this. The closing stock of $60,000 is then deducted. That is $376,000 minus closing stock of $60,000. And the cost of goods sold is now what? $316,000 is obtained. So $376,000 minus closing stock of $60,000. We get our final cost of goods sold of $316,000. Finally, the cost of goods sold, which is $316,000, is deducted from the net sales. The net sales is what? $395,000. We deduct cost of goods sold of $316,000. Then, which is $395,000 minus $316,000, and a gross profit of $79,000 is the outcome of trading activities for that particular period. Note that the only item included is the carriage of what? $6,000 added to the purchase. As usual, the closing stock of $6,000 will be carried to the next period as of opening stock. Well, we have come to the end of the video. There will be a part B whereby we go to, so the first stage, what we've done is that what we have done the trading aspect of the business. So in the trading aspect of the business, we deal only with what? The buying and selling of the organization in order to arrive at our gross profit or what? Or loss. That's what we've done. I would do the part B, which is when after getting our gross profit, we go on to the second stage, whereby what? Our gross profit, we take all the expenses and we deduct it from our gross profit. Thank you very much for watching this particular video. Please go and look at and work for the second part, which is the second aspect of the trading profit and loss, whereby we take our gross profit and I say we deduct it from expense. Please like and share to others in order to encourage me. Comment on it so that I can improve upon my performance. And please subscribe so that my next video can be sent to you. I'll be making videos weekly so that my next video can be sent to you. Please, as I've said, practice make man perfect. You can record this, go over it several times so that you understand the principle, you master it so that trading profit and loss account will not be a problem to you anymore. Because as I said, without trading profit and loss account, your inability to calculate trading profit and loss account shows that what you are not an accountant. So please, every accountant should be able to prepare trading profit and loss accounts. Before ending, as I said, I'm a chartered accountant. So if you need anybody to keep your books for you or offer other accounting services, and also if you need somebody to teach you accounting, I'm available. You can click on my email below so that you can get into contact with me. Then we discuss about it. Also, please practice more questions. If you need more questions, you can contact me so that I send you more questions. Bye. To the next video.